You may begin, sir.
Okay. Let's call this meeting to order. At 10:32. Let's have the roll call. I'm Bob Stevenson, Chairman.
Sean Weisky, Human Resources Director.
Tim Dodd, Deputy City Manager.
Richard Patel,
Firefighter.
firefighter. I don't know what I am anymore.
Christy Kiesel with GRS, the Plan Actuary.
Monica Kinnerman, Staff Liaison.
Beverly Coleman, Board Member.
Shelley Ward, Board Member.
George Gregory, Old Heart Police.
Sydney Ashelman, Innovest.
Wendy Dominguez, Innovest.
Rita Russell, Council Liaison.
Jim Woodward, Board Member.
And who's with us online?
Keith Lockwood, retired firefighter.
Paul Wood, I'm virtually carrying Christie's bags today, also one of the actuaries.
Hi, Paul, welcome.
Huh.
I think that's it.
That's it.
Wonderful.
Did anybody get a chance to review the minutes or have any question changes from the August meeting? Otherwise, I will entertain a motion that they be approved.
So moved.
Second,
Second.
George, all in favor?
Aye.
Aye. Okay, any new business? Monica, did we have something that we were gonna fit in here, or is that going?
Yes and no. I wouldn't call it new business, but we do still have an employee that started 4 years ago that was not offered the opportunity to participate in the pension plan because we didn't have an HR team, we didn't have a benefits person, so he was just put into the 401A when he wishes or would desire to be in the pension plan. Like I said, he's been there 4 years, so we don't know the impact of moving him out of that plan and into this plan. So this board has discussed it. However, we haven't discussed it with the 401A committee and get their opinions on moving him out of that plan and into this plan. Innovest's suggestion is that we ask the city attorneys to reach out to ERISA attorneys and find out the implications or
Procedure or?
right, if it's possible, if that's something we want to do, if that's a precedent we want to set. So that's the next steps there. When he first approached me, there were several employees that were affected by this, but he says that they've all left and it's only him, and he's still interested in moving forward with this. So that's where we're at. Those are the next steps that we will take, and I will bring back any suggestions to the board.
Okay.
So I asked this question before probably, but so would the money that went into the 401A be transferred into, or he just starts, we don't know where, he just starts from day one when we admit him?
Because he's fully vested in that
Okay.
plan. After 1 year, he's fully vested. So those are technically his dollars. So that's why I want to talk to Mission Square to see if they have any issues with that. Do we
Okay.
just end that plan, and whatever is in there is his, and then we move him to the pension plan fresh, so he doesn't double dip.
Okay,
He would start fresh in that plan. He would have to do the 5 years to be fully vested. He intends on retiring from the city. So he just wants an opportunity to participate in the pension.
So in that
He's
case,
never
the
given
pension would be a better plan for him, correct?
Well, it would go the rest of his life
Yes.
and the rest of his spouse's life,
Spouse's life.
if that's the option that he chose.
Yeah.
So, and like I was saying, now, most people don't offer pensions. So if you
Yeah.
have the opportunity, of course, you're going to want to take it.
Yep. And
He's saying he wasn't given that opportunity. And I can find no files, nothing, that say he signed otherwise.
And that would explain a lot that happened during that time, because we weren't getting many, if any, members. So it's a conundrum, but I would be on his side, and hopefully we can make that change. So,
I will let you know when I find out.
yep.
Is that the only person you know that's working here right now that is in that boat?
It's the only person that has spoken up. I don't believe it's the only person that's in that boat. Because that was a time period, one, it was during 2020. So during the pandemic.
Right.
So I imagine there would be more, and that would be the issue, is this something that we want to open up?
And is
part
that
of-
why we have to speak to the attorneys to figure that out? I mean, because we may, if they weren't offered it and they may not know that there's that option either. And if we give it to this person, we probably
have to
would need to
consider?
offer it to the other ones.
Correct.
That's something that you may look at, Monica, and see if you can figure out any hires, any new hires up during that time.
I would guess, since it was pandemic time, probably wasn't too many, if any, others.
And of course, procedures, operations at that time were different than what they would normally be, because people aren't coming into the office. I would think there would be more communication because of that, but we didn't have a staff at the time, from what I understand.
So was there an HR director at the time? I'm trying to remember.
Yeah, so I started in 2020 as well, and I can speak from my own anecdotal experience that, yeah, things really weren't fully explained there. There was an orientation, but it was half day. I don't think it actually included a benefits module. We were in person with restrictions, of course. But yes, I remember I told Monica I had to do some digging myself, because the information that was given to me made it seem like I was eligible for either the 401A or the defined benefit, which I wasn't. And so I had to kind of look into that. So I will say from my own experience that yes, I don't think a lot was communicated that back then. That being said, of course, we have to be cautious from a legal perspective and from a financial perspective about what this looks like. And I will say Monica has rectified it going forward. She now speaks at, I think you don't know this, but she speaks at orientation. She goes through this in great detail, and we haven't heard of any issues recently, right? So,
Not on my watch.
so we have taken action to mitigate it going forward.
I may know of one, but
Yeah, let me know. Or
I'll let her know
Yeah.
that. But should I wait or until this
I would
gets
wait.
resolved one way or another? Or-
Yeah, I would wait, because we don't know
Right.
if this is something we're gonna move forward with or not.
Okay, copy that.
So we'll see what the attorneys.
Well, I know just from a retiree's perspective, there was a time in there that I just didn't ask anything because I did not trust any information that I was getting out. I pretty much settled things in. But up to that time, there were people that I knew the ins and outs of it. But at a certain point, they were gone, and it just didn't seem to be worthwhile to me. So I can vouch for what Tim's saying too. So,
It's unfortunate.
yeah.
Another question along those lines, is the board aware, I imagine this is the decision that the board made. If someone doesn't, I give them the option to go into one plan or the other. I send them a comparison sheet so they can make that decision. If they don't make a decision, they are automatically put into the 401A. Is that the board's understanding? And should it be the other way around? Because I think at one point it was. If they didn't make a decision, they went into the NERP.
That is what, when I got onboarded back in 2021, that's what CPS had told me their practice that they inherited from the prior administration. So it was determined that it was cheaper for the city to do that, and that was why they were doing that, because the NERP is significantly more expensive, so they're defaulting everyone to NEP.
And that's our understanding.
Did the board ever make a decision on that?
I'm not sure. That was the practice when I came in, and so I think that was just what we continued doing.
Okay, so Jim, do you remember, because you were on this board back then before Sean Weisky came?
I don't remember 2020. I stayed in my house all the time.
I'm not sure it would be a board decision. I mean, wouldn't it be a settler decision from the city to decide which, I don't know, I don't know, maybe that's another legal question.
I would have thought the same as you, Wendy, as well, especially since this board is in charge of specifically the non-emergency
Right.
retirement plan.
Right.
Okay.
So it would likely be the city's decision, because also in this plan, the city is taking on that investment risk particularly, whereas in the other plan, it's more so the members taking on that additional risk, and that's why this plan is more costly for the city, and likely why they chose to make that the default.
Which makes perfectly good sense.
Monica, they
I
only
wanted
have
to know for my own understanding.
7 days to make a decision, is that correct?
It's a little more than 7. So on their start date, they have to notify me by the following Friday. And that's the plan I'll put them in, because that's when payroll would run.
We could go back probably and look at the point that they split the plan, which I think was in the mid-90s, somewhere there would be a record of that, and that was probably when the precedent was set up. I know that when people were promoted into mid-manager, I think they were given the choice at that point, but I'm not positive on that, so.
And I don't think we do that now, because it's quite confusing.
Yeah.
Moving from one to the other.
Yep.
Do you recall at all? Were you around?
I started in 2002, so I was given a choice.
I know I was given the choice when they did it. And that's all I can remember.
And Rob started in 96, so he was given a choice as well.
I think that was 94, 95, somewhere in there.
Okay, just my curiosity, so thank you for entertaining that. I'll let you know in our next meeting what we found or what council suggests.
Okay. Thank you.
You're welcome.
Do we have any public comment? I don't see any public here. So we will move on. GRS, do you have anything for us?
We have nothing for you today, but
Oh,
the
darn.
evaluations will be coming sooner than we know it, so we'll hear plenty from me next year.
Yeah, this is the last meeting of the year, so we look forward to that. Okay, Innovest, thank you.
Sydney's gonna kick us off.
Yes. Alrighty, we're starting off with a little bit of fiduciary education. We do this in the third quarter every year, just to refresh everyone with their fiduciary duties being on board. So we'll just walk through some duties and then some functions that we serve as fiduciaries as well, just a good refresher. So some fiduciary duties that we have, these are the most important. Duty of loyalty, that's your duty to look out for participants' best interests. So we're always putting participants first. We're taking we're talking about settler functions, taking our settler function hat off and putting our committee member hat on. And we're really, when we make decisions in this room and on this board, that we are making decisions just in the best interest of plan participants. Duty of prudence. This is the duty to act as any prudent person would in your situation. And if we don't have the tools to kind of make those decisions, then we hire outside experts like GRS or Innovest to help you with those decisions. The duty to diversify is, when we talk about our DB plan, we have all sorts of diversifying investments. We have private assets, we have equities, bonds, cash, all sorts of things. So we are diversifying, providing a very diverse pool of assets for participants. So we're really doing a good job there. Duty to follow plan documents, fairly straightforward, but really, really important that we're following, anything that we say we're doing in a plan document that we're actually doing in practice. And then avoiding conflicts of interest, also fairly standard, but just, want to make sure we're avoiding any conflicts as committee members. Some functions that we serve as fiduciaries: selecting and monitoring investments, that's a fiduciary function. Innovest helps with this in great detail. Selecting and monitoring service providers, that's important. So selecting, continuing looking at GRS services, Innovest services, your custodian services, ensuring that the fees are reasonable and the services that are provided are necessary and we're using those services. And then those last two bullets: interpreting plan provisions and application of plan terms, and then ensuring the plan operates in compliance, that when new regulations come out and we're following our plan documents, anything legal, things like that, that we're just on top of all of those functions. Those are all some ways that we're serving as fiduciaries. Any questions on this? Great. And then a trend that we're seeing, which kind of falls under this, let's see if it's a little slow today. Collective investment trust. I don't know if we've talked about these recently, so we'll just give a quick refresher, and Wendy's going to talk about some opportunities that we have in the CIT world today when we talk through the share class review. But collective investment trusts, or CITs, they're kind of getting a lot of traction in the DC world, but they've actually been around DBs for a really long time. They used to be pretty complicated and manual. I think they were around and they started in the 1920s, so as early as then they've been around for DBs, but kind of became more modernized and more like mutual funds in the early 2000s, were traded on some of the same platforms as mutual funds and things like that. So today we view them really similar to mutual funds, but really all they are is kind of a separate pool of money that tries to mirror that mutual fund. And their biggest draw is that they're a lower cost typically than the mutual fund, which sounds really great in theory. But we do have, there's some differences between mutual funds and CITs that we like to keep on top of. Just because they offer at a lower cost, sometimes we still don't see that net of fee performance outperform the mutual fund. Even though we're getting a lower cost, sometimes they just have a harder time replicating for a variety of reasons, because it's its own pool of money, and these are really available to institutional investors like retirement plans. There's just less investors in them compared to a mutual fund where we have all sorts of retail investors and things like that. So we see some difference in cash flows, which can sometimes impact performance and things like that. CITs are also a contract between the city and the mutual or the asset manager, the mutual fund company that's providing the CIT. So it's a separate contract where now we don't really operate in that capacity. So it's a little bit different than mutual funds in that regard as well, which can come with some attorney reviews of CIT contracts and things like that. So they're a little bit different, but we do, when we find an opportunity in CITs that we think is attractive, we'll bring it to you on your annual share class review. So there were some in the DB plan today that we'll talk through that were some attractive opportunities that we'll kind of talk through the pros and cons of that. So flipping down to page 12, our executive summary. Just wanted to point out the year-to-date performance here, looking at almost 11%, which is really, really solid. We'll talk about the markets in a second. Thinking about how diversified we are with all the alternatives and everything, and how well just the equity markets have done and fixed income markets have done. The fact that we're still so diversified and really looking good from a risk perspective compared to the markets, and just how well we've competed against that. So 11% really strong. And always fun to look at that cumulative performance down here in this bottom right chart, where we started in 2007 to where we are today. Just exponential growth, overall almost 300% return overall since we started. So just fun to see that. Skipping to page 14, talk through the markets a little bit.
Can I just say one thing
Oh,
back to the page 13, Sydney?
Yes.
This picture, I think, is worth 1,000 words, but this is really why you invest. If you look at the green mountain, that's the current balance in the plan, and the kind of teal colored line is the net amount invested. So if you think about what we started with, how you paid benefits all these years, we had investment returns. So the net amount invested is only about $6.4 million. But the ending value is 44.5. So that's why you invest, and that's why a plan like this is successful, is because of markets and investing and solid actuarial analysis and contributions over time. So just wanted to point that out.
And that's why we have you.
Well, thank you.
So there's been a lot going on, I know, in the news and the economy. We'll talk through the economy as well. But when we look at the markets overall, they've been very, very strong. And we just see a lot of positive, no negative across the board. This is from the period ending September 30th. We have third quarter numbers, year to date, and 1 year number look backs for all sorts of asset classes here. You know, we've been preaching having a diversified portfolio for forever. But we're actually kind of seeing some benefits of that with international and EM doing well, core fixed income doing well. You know, it's not just domestic markets that are doing well lately. So that's been exciting. We see those developed and international emerging market stocks numbers. I mean, just really, really strong outperformance compared to the others. Year to date, I think EM is up over 30% now as of today. Which is just really exciting, something we haven't seen in a while. We think there's a lot of opportunity in those markets, a lot of inefficiencies. The weakening dollar is a strong provider for that, some of those returns as well. Large cap stocks continue to do well as well. You see, 17% return on the look back for 1 year. We were talking in the last meeting, I guess, in this plan it's less relevant, but still we just think about as investors in general, we're starting to get used to some of these really, really large returns. It's just crazy how well markets have been doing for so long. Small caps did really well this quarter. They were the best performer, up over 12%. When interest rates get cut, that usually is a good driver for small cap stocks. So good to see them have a win this quarter as well. Slide 15, talk about the economy a little bit. GDP was up from the first quarter. Really in the first quarter, we saw some downturn, if you remember, with the tariffs, the announcements of the tariffs. There's a lot of companies that imported a lot. So our imports were really high, which caused the GDP to be down. In the second quarter, we kind of just went back to normal. So we kind of reverted back. Well, we won't have 3Q numbers. They're thinking until probably the end of November now. We're lagged because of the government shutdown. We don't have that data. But we'll see kind of where we end up there. We continue to see, that increase in GDP. A lot of it is from consumer spending. That continues to be a large driver of our GDP, a really large chunk. Services sector was important there. Healthcare and financial services were a big part of the spending. We kind of break that down for GDP. The labor market has a lot going on. Unemployment rate it's slightly upticked in August to 4.3%, which is historically fairly normal. But we've been hearing a lot of stir. It's hard to enter the workforce, and there's a lot of stir. And I think where we're seeing that come through now in the data is jobs added. So there was only 22,000 jobs added in August, which is fairly low. We looked back in 2024, the average jobs added per month was around 185,000. So we're fairly low in new jobs. We also have, a lot of baby boomers retiring. And so there's not a lot of replacement of those jobs, it seems. It's kind of in a low hire, low fire situation where companies are kind of waiting to see. We talked about in the last meeting as well. We know there are some layoffs in between. We just haven't been able to see that come through in the data yet. So we'll kind of wait to see what the next couple of months look like with some of those layoffs we know that happened interquarter. And then corporate profits, S&P 500 companies grew earnings over 8% in the second quarter. In the third quarter, they're estimating that to be about 13%. So continue to see really strong earnings. And we talk about, you hear all this stuff about the potential bubble, right, with AI and all these things, but then we're seeing that these companies are still earning a lot. And back then, there really weren't earnings to back a lot of those companies. So we're more hopeful that that hopefully won't happen in this case, because we're seeing those companies really do have earnings to kind of back up some of this large growth that they're having. Consumer sentiment was down in August, and typically, that's correlated with the strong stock market. So it's kind of interesting to see that dip. It could be for a variety of reasons. I think there's some frustration over continued inflation and just cumulative inflation, several years of that now. I think we're all feeling that. This inflation box in the bottom left-hand corner, it talks about kind of the CPI. Inflation did go up in August, up almost 0.5%. And then, shelter and grocery prices we call out there also have increased, which, impacts all of us. So restaurant prices as well, up 4% is fairly significant. But gasoline prices did decline by a decent amount, so there's some offset there, which is positive. There were 2 interest rates cut recently. September and October, we had 2 25 basis point cuts. So that's helpful for the markets, right? It helps businesses and consumers as well. Some risks that we're seeing, we talk about the housing market. 12% of GDP, fairly significant portion of GDP, the housing market. We're seeing some lackluster activity there. We were also talking in the last meeting, I thought this stat was just kind of staggering, that now the average age to buy your first home is 40 years old in the United States. And the average age to buy your second home is 59. So really just seeing some interesting statistics in the housing market, and we'll just have to see how that kind of all plays out. If we move to slide 17, this is just kind of, we're talking about the job markets and new jobs added. This just shows that kind of in chart form. We see this little dip here in July down to 28,000, and we see kind of straight across the board the last couple of years. So we just see that that number has gone down, new jobs added. Historically pretty low compared to what we've seen since the financial crisis. But a positive on inflation, wage growth has really been able to keep up with inflation, which is positive. And you see this brown bar here on the graph shows growth in wages, and it's been able to outperform that inflation number in blue, on that blue bar there. So that's positive for consumers, that employers on average, obviously that's not every employer, but on average has been able to outpace those inflation numbers. So that's positive. We'll go to page 23. Just want to show, all the great performance that we've had in the last several years. We don't see any red in any time period that we're listing here. All just green, and a lot of dark green, which is really positive performance across the board, even going out 10 years. So we just had really strong markets, which has really been positive for investors and for this plan as well.
Great, well, I'll take us over on page 28. This is our report card. Really clean report card. Remember, any concerns are noted in yellow or red. Any changes from quarter to quarter are white or blue. So we do have one change this quarter. We have a new minor concern with Harrison Street Real Assets Fund. They are going through kind of a rebranding under Harrison Street. They were Versus. If that name Harrison Street doesn't sound familiar to you, it's because it was Versus. So they are going through a rebranding through some new ownership. So whenever something like that changes, we want to keep a closer eye on it to make sure that it's not going to impact performance or asset base. So minor concern there. And really the only fund that we have a minor concern on performance is the Euro-Pacific Growth Fund. Performance there is dramatically turned around in the most recent quarter, so we can look at that in just a moment. But overall, again, very clean report card. On page 30, we'll start talking about the individual funds in the plan and how they're performing. If you look on an overarching, how are the funds doing in total? 9 out of 14 are above peers for year-to-date. If you go out 3 years, 13 of 14. So the last 3 years have been really strong for the individual managers in the plan. A couple ones that I wanted to highlight. On page 30, Thornburg International Equity, that was your the best performing fund year-to-date, almost up 30%. Slightly behind median, but still just tremendous performance for the fund. I mentioned the American Funds Euro Pacific performance has turned around. You can see that in the quarter in the 8th percentile, up over 6%, and then year to date in the 35th percentile, up 23.48%. So as Sydney said, the international markets have just screamed so far this year. And you know, it's we talked about this in the last meeting too. It's challenging internationally. If you would have told anyone at the beginning of the year with all the tariff talks, all of the uncertainty around foreign trade, that this year would be the year it finally paid off to be an international investor, I don't think many people would have believed that would be the case, and it was. So you have to be invested in order to participate, and so it was a great year for that. On page 31, kind of one of your the benefits of diversification is that you get smoother performance, but also kind of the downside of diversification is you'll always have an investment in your portfolio that you don't like. And that today is the GQG Partners Emerging Markets Equity Fund. So while, you know, a 6% year-to-date performance doesn't sound all that horrible, if you look at some of the benchmarks up closer to 30, you can see the fund did miss out on a pretty sizable return opportunity so far this year. They have been avoiding a lot of the technology companies and have moved into financials. And often decisions that investment managers make, you have to go back to the, did they suddenly become stupid overnight? No, it's that their strategy just doesn't happen to be working in this market this time. So we will be, I think, patient with GQG. They're still a very, very talented in emerging markets and international markets asset manager, but they were probably too early to move away from technology and into financials and become a little bit more defensive. So what's the good news about your portfolio is we're not in 100% GQG for our emerging markets exposure. We've kind of split that with DFA, who has had a more kind of closer to the benchmark returns so far year to date. So good news, bad news there. On the fixed income side, the fixed income in the portfolio has done really well. For quite some time, returns were negative in fixed income or even flat to zero. So to see almost a 7% return for Dodge and Cox Income or 8.2% return for PIMCO Income so far this year is just a tremendous performance. And if that could be your building block, that's the conservative building block in the portfolio. And if we can start there and add equity returns on top of it, that suddenly becomes meeting your actuarial assumptions a much easier task than it has been historically.
It's pretty good when our fixed income is above our goal.
Yeah, absolutely. It begs the question to say, well, should we just be in that and take less risk? And that's, what if the plan were ever to close and get to a point of full funding, then that's where you have those discussions to say, we don't need the risk, let's just clip the coupons and just be in the fund. But the way that your plan is managed and how you allow new participants to select it, which is amazing. We think that its asset allocation is good. Right now, we will come back in February with any recommendations for changes in asset allocation, but so far so good there. Real estate was a struggle in the portfolio for a little bit, but seems to have turned the corner, up about 4% year to date. We've got some hedge funds in there that are performing very well in addition. And then on page 32, these are more of your alternative asset classes. And again, really strong performance across the board. We have Ironwood that is very kind of tried and true quarter after quarter, really solid, stable performance. Tortoise, this is investing in MLPs or pipelines that transport oil and natural gas throughout the US. So really strong performance there. This fund in the quarter that we're in is a little bit lower. They're off about 6%. It's one of the only areas in the markets that have seen a pullback so far in the quarter. But still, you look at the last 3 years, we're annualizing at a 23%, 5 years at almost a 29% return. So the addition of this portfolio, this fund in the portfolio has been extremely positive. And then we have other real assets. So this is infrastructure, investing in liquid natural gas and airports and toll roads and just a lot of different things, again, to try to smooth out performance and get exposure to a lot of different areas. We have private equity. Those returns aren't in yet because they lag, but we expect that we would have seen about a 12% year-to-date return out of that fund, close to benchmark. Private debt, giving those same private equity funds loans. So that fund has been incredibly successful as well. So all in, as Sydney pointed out on the first page, your year-to-date performance is 10.9, up about 4%, a little lower than 4% in the quarter. If we would have just been in a 60-40 portfolio year-to-date, we would have been at 11.33%. I did the math. That's not on this page. But we're beating the 6% return goals, which is our actuarial assumption. We are slightly behind benchmarks, which means that it would have been better just to have been in U.S. stocks or international and U.S. stocks probably so far this year. But we're diversified, so we'll take a smoother ride to get there. And I think page 33 is really instructive about that smoother ride approach. We haven't seen a lot of negative markets recently. The most recent is 2022, and it was a bad market because it was not only, if you remember, equities were down significantly, but so were bonds. So in that environment in 2022, this portfolio lost 10.72% when the S&P was down 18 and the bonds were down 13. So again, that diversification when we're in bad markets should pay off and has. So, any questions about that? That was really all we had to share today. Again, no changes in any asset manage. Oh well, that's on the first slide. I have 2 more things to share, but only on the report. We'll be doing an updated asset allocation study next time we meet.
Pretty decent report card.
Yes, it was a good report card. Thank you.
Thank you.
So then the next thing on our agenda to cover is an updated investment policy statement. It's in your packet and it is redlined. And we just think it's best practices to go through this every year and see if there's any changes. I can tell you that there's no changes really in the body of the document. The only change is that we've updated on page 10, Exhibit A, then the asset allocation targets. Can you remember last year in February, we updated our target allocation slightly, made a few slight changes. So this just memorializes those changes. And you can see it's, again, very, I would call it administrative in nature. So, Monica, do you think we need to have, or Bob, do you think we need to have a motion to approve this and have it executed, or I think that's what we, yeah, I think, and they are very small, but
I think we should.
Okay.
Just to make sure that everything is completely in order. Does everybody understand what we're doing?
So I do have a question on the lower limit. Should there have been a line through the 4?
Yeah, I think there is one. It's just, it's hard to see on the crosshair of the 4. Yeah, you're exactly right. So it's not set, it should just be 7.
Okay.
Okay. I will entertain the motion that we accept these changes as submitted.
So moved.
Any discussion? All in favor?
Aye.
Aye. Any opposition?
So is there a second to
No, we
that?
needed a second.
We need a
Oh, we
second.
need a second, I'm sorry.
I'll second it.
Jim, a second.
There's one right there.
Okay.
Rules.
Okay. All in favor? No dissent? You'll note that it is carried unanimously.
Great, and I can send a DocuSign, is that easy
Yeah.
for you to sign, and then we can, and then we'll get a final to you. Okay, the last thing on our agenda is the share class review, which is the, this document that we handed out. It is something that we update annually, and the reason why it needs to be updated and looked at every year is that the math behind all these share classes that you're invested in changes. New share classes come out, again, it's exact same investment pool, but the mechanics about the fees and who collects the fees can be different. So what we do is we highlight the fund that you own in the dark gray at the top. So for example, it says Harbor Capital Appreciation. This is a fund that's in the plan today. The expense ratio is published at 0.67, so that's what they advertise. There's actually a record-keeping offset of 0.08 in that fund. So the net, that means that Schwab collects, gets a discount essentially on your behalf and gives it back to you. And so the net expense that you are paying is 0.59. So then what we do is we say, well, there's a bunch of different Harbor share classes, Harbor Capital, there's CITs that Sydney just went through, as well as other share classes. So is there an event where the math is better that gets a lower cost to this plan? And you can see that there is this Harbor Capital Appreciation Class 5 CIT. We can get the 0.59 that we're paying today down to 0.38%. Now to do that, we would have to invest in a collective investment trust. So we would sell out of the mutual fund and we would buy this collective investment trust. When you buy a collective investment trust, there's additional paperwork. It would be something that you would physically have to sign. When you buy a mutual fund, we trade it on your behalf. You don't have to sign anything. But when you buy a collective investment trust, there is paperwork. So the actual cost that you would save on this is about $6,300 a year. If you take how much you've invested in Harbor Capital Appreciation, it's about $3 million. The difference in expenses is 0.21, so that's $6,300. So I think you have to say to yourself, okay, if is it better to save $6,300 or do we, to do this, we're going to probably have legal expenses. An attorney is probably going to have to look at the collective investment trust document on your behalf. And it's a little less transparent. With a mutual fund, you can buy and sell in a day. With a collective trust, if we wanted to get out completely, it could take up to 30 days to liquidate and get out. There's also a little bit of tracking error versus a mutual fund. If you think about it, and Sydney kind of talked about this, the collective investment trust is still sizable. I mean, this investment vehicle, but it isn't as big as a mutual fund. So when people go in and out, cash flows impact performance a little bit. So you could be in a situation where someone else gets out and it causes a liquidation in the fund and performance is impacted by that, or vice versa. It could positively impact performance. So it is a change in structure. It's a little less easy to utilize in the plan. And the fee savings is $6,300. So it's not, I don't know, sure, any $6,300 is important to anybody, but is it, in the scheme of a $44 million defined benefit plan, is it significant enough to make that change? We'll let you all make that call, but yeah.
The 6,300 is the net or the gross number? I mean,
It's the difference between paying 58 net and 20 and 38 net. So it's 0.21 on $3 million. So it's 6,300 a year for however long you hold it. And if that dollar amount goes up, it could be more than that.
okay. And you were saying on the sale, the actual, if you call it today, it's 30 days from now?
It
when
could be.
Finally sells?
It could be, yeah. And yeah, it could. It doesn't necessarily have to be. But if, for example, I think they always have the option to say that to you, that you can't,
Yeah.
no, we're gonna get it to you in 30 days. I know you put it in today, but we'll get it to you in 30 days.
That's when they'll get it to you?
Yeah.
The actual sale date? They
The
don't
actual,
say-
no, they don't, yeah, the actual sale date would be the date that you sold it,
Okay,
but it
good.
could take a little bit of time to get you the proceeds, is
Yeah.
I think is what they're saying.
Well,
Yeah.
does this affect you in handling things a little bit? Not really,
No,
right?
not really, no, it doesn't. It adds, I would say it adds a sliver more complexity versus what you have today.
Right.
And then again, you know your legal review process. The other thing is that you'll have to sign their standard agreement, which will say the laws of Delaware, I'm sure, and
Yeah.
will say that you agree to mutual indemnification, which I know are two issues that are problematic for municipalities. So we can get you the language. And if you want to have it run by your internal counsel before you send it out to external, so it doesn't really maybe cost you anything, maybe we could look at it and see if there's anything in there that they absolutely say is a no-go from a signature standpoint, and then we can go from there. How
Well,
does that sound?
my personal opinion is I would just as soon keep it as simple and transparent as possible. Jim?
I would agree.
I agree.
And why jump through all these hoops for 6,300? Now, if it was 63,000,
Yeah,
it
absolutely.
might be worth it, but, does anybody else
Yeah,
have it?
you could eat up 6,300 in attorney's fees.
Yeah, exactly.
And way
Plus some.
Yeah,
Yeah,
yeah.
pretty quickly, so.
yeah. Do we need a motion on that, do you think, or
No, I don't think so, because we're not, if I
if
think.
we were going to change, I
Right.
would ask for a motion,
Yeah.
but since we're gonna stay, I think we'll just leave it as is
Mhm, yeah.
and continue on.
I agree, and I think we could put the notes, in the notes at the beginning of our report that we talked about CITs, we talked about this one in particular, and we decided to stay the course with the current fund because the savings wasn't significant enough to make the change.
And make maybe a bold face in the minutes or something to accent that, Monica, if you would.
Absolutely. Do we all agree
Is that-
to stay?
Okay, great. Well, that was excellent discussion. Sorry that maybe it was, no, it really was. I mean, and ultimately, we had fiduciary education earlier with Sydney, and we, as fiduciaries, you're not required to choose the lowest cost vehicle. You're charged with evaluating all the pros and cons of any decision and making an informed one. And I really believe this was exceptional discussion and exceptionally informed. So thank you.
Yes, and I think with your record, we want to give you as much leeway as we possibly can and keep up the good work.
Thank you. We'll try. Well, hopefully the markets will cooperate.
Do we need to discuss anything on the markets? I mean, it seems like there's some discussion that things are getting a little overheated perhaps, but I mean, personally, I take our diversification enough that we're gonna handle whatever comes, and when we lost everything in 2022, we still weathered the storm and have bounced back, so I don't think we could get much worse than what we went through. And
Yeah, hopefully not.
Yeah, don't say
that.
yeah,
Yeah, 2008, 2009 were definitely, kind of the 1 in 100 year events in markets. And we haven't been anywhere close to that. Even 2022 wasn't fun for sure, but it wasn't anywhere close to what we saw then. So, or COVID. I mean, but that's the issue, is that it's COVID. Who could plan? I mean, who could think that that would happen? And then there was, the mortgage defaults, and maybe you could say you could see that coming, but it's often I think the black swans are things that you could never even plan for. So, but having money in a lot of different pockets always makes you feel better, and it works too. It's not just about feeling, but it works.
Yeah, yeah. I mean, does anybody have any discussion, questions or anything? I'm just happy to have this going forward, and with the track record, I think it's hard to beat.
Thank you all. Thanks for your confidence.
Okay, thank you very much. Let's look at the COLA request if we can. Where do we stand? Our finance director isn't here, so.
He is not, but he did send, and it was included in your documents, a presentation that the presentation that's going to be before the council. And I believe there was a date in November, and that date's been changed now to January.
Yeah, that's what I think.
Looking in the system, it says January 12th.
To vote on this
I
or
believe
to?
Discuss it.
To,
Present it or what? I mean,
well, I did bring it up at the council meeting right after our last meeting, and there was pretty much unanimous support for it. I mean, we didn't vote on it. So if we vote on it on the 12th of January, when will it happen?
So I'm reading right now what I see on iCompass, and it actually says study session on January 12th for a purpose of presenting for discussions to request a stipend payment. So I can talk to Kevin about, he's out today, but.
Why didn't we schedule that earlier? Because I shared with council that we wanted the payment to go out the end of January. And I think I asked also if it was included in the budget for 2026.
And I'm
Is
just,
it?
Don't know, but I can check on that. I will reach out to Director Ingalls and ask why this, and it could just be an error in the system, but that's what I'm
Okay.
seeing right now in iCompass. And ask if it's budgeted.
Okay.
And then through Monica, we can get that information back to the board.
So as far as I understand it, the plan was to go through this presentation and present it to council for them to make a decision. We also wanted to make sure that anyone who wanted to have, include a statement from the old hire plans, that they add their statements. So I can reach out to the board and you can send them to me, or I'm happy to take them from you, whichever you're more comfortable with.
I don't know, but I will find out how we want to do that. I know that there was a number of people planning on attending the meeting in November. But if that doesn't happen. By the way, thank you for your support.
You're welcome.
And Monica, I never saw that letter. Is there you mentioned a packet?
Yeah, it came with the agenda on your.
However, it doesn't download very easy because it says it's not secure.
Yeah, I'm trying to download it now and
See,
it's not, yeah.
And it may not download. I had trouble getting it. And so if I had trouble getting it, you're not going to get it off of a regular computer.
I can see if I have the one. I should have the one from Kevin.
Is this something that maybe Christine Hart would have? I could go ask her. Jenny.
I have it right here.
Okay.
I apologize that you guys couldn't get that easily. Okay, so can we all see that? I don't like that. Should be looking at the whole thing. Okay, it's small. Can you all see it?
Is it possible to get a hard copy, especially for the both higher employees?
Yes, I didn't realize you guys couldn't see it. So yes, I will send it out. This is the presentation that he prepared. Just let you guys read through that. It basically just talks about the history and how there hasn't been an increase since 2001. And the amount of that increase versus as compared to inflation.
And so my question, I do have a question about this. Can anybody answer, I mean, why was that included? Because we decided that we weren't, I mean, we're not paying more to FPPA for this, correct? Or
Yeah, I think going this route keeps the city from having to pay FPPA.
so that $114,000 is what we would have paid to FPPA. Is that correct?
I can't speak to that. I'm
I believe
assuming.
those are the actual contributions that went to FPPA during those years. So it's a comparison of what was actually paid to FPPA is what's on there right now.
So
that's in
the,
2021 versus.
okay.
Thanks, Christine.
So it's the difference between what we paid in 2025 and 2021?
It's the required contribution amount. So the amount that was calculated that needs to be contributed for the plan currently.
And are we contributing that to the plan?
I don't know that, but it looks like the decrease is tied to the number of beneficiaries, right? So because the beneficiaries decreased, so too did the contributions.
Fewer people to pay benefits to.
Okay.
And this is just the request itself.
And Kevin will be submitting this, correct?
This is the
Yes.
presentation that he intended to present to council. And then, as I mentioned, any statements that the members would like to make, we can add to the presentation.
Monica, if you wanted to submit this to print, I can go ahead and get hard copies for everybody, since that was Rita's request.
Thank you.
And I'll go grab them.
And Deputy City Manager, you will check to see if that's a firm date in January instead of?
Yeah, I'm writing an email right now to Director Ingalls, asking that because you brought it up previously during council members' choice and your fellow council members supported it, if we could just move it to an action item. And also, I'll see also if we can maybe move it. The December meetings are getting pretty tight, but I can see if we can move it forward in December too.
Because if we just had a study session in January, it's not gonna happen till March or April, correct?
Most likely, yes.
Yeah, I want that moved up sooner.
And again, that could be an error, is just what I'm seeing.
Okay.
Yeah, because that was the whole gist of having them meet this last quarter.
Yeah.
Right.
It's supposed to be November.
I guess we don't have any control over when they change their dates. Council.
Council should have some.
So that's where we are on that request.
Okay. Thank you.
So we should have more before our next meeting, and we'll keep you updated on that. Anything else on that one?
I don't think so. I'm gonna Make sure. Do we have any retirement approvals or notifications?
I do.
We always seem to.
So those beginning distributions were David Gonzalez, Robert Warwick, and Joyce Musgrove. There was one notification, well, I wasn't ever formally notified of a passing of Wayne Niles, and I have reached out to his family and I've not gotten any responses. So as a result, I paused the distributions until we can hear from his family.
Distribution?
Yes, I just paused it until we can find someone. I don't have a death certificate, I don't have a formal notification.
And you haven't been able to scare any contact up?
I have gotten no response. So
Wow.
until we know more, it's just paused. And I heard about it from another employee, so. Is it true?
Yeah.
I don't know, because I haven't heard from the family, so. So the payments just aren't going into,
Yeah, it's another Netherland.
so I'll report more on that one as I know more. And that's it, thank you. So next is board members' choice.
Yes. Does anybody have anything they want to bring up?
Are we good on the phone? The phone, sorry. Okay, you know what I meant. Online. Nothing there. Our next meeting is February 10th, 2026. I will get invitations for that meeting and all of the meetings for 2026 to you and on your calendars in advance.
Okay. We are ready to adjourn, and it looks like everybody's ready to get out.
Waiting on you, Bob.
Let us call the meeting adjourned. Thank you all very much.
Thank you again for joining us
Thank you.
on a different day, different time. More to come. Have a great holiday season.
Yes,
Yes.
it's hard to believe, isn't it?
Oh,
Where'd
you're
the year
just
go?
good.
I know.
Thank you all on the phone.
Thank you, everybody.
I mean,
Thanks,
Happy
everybody.
holidays,
Thank
everyone.
you. Thanks, Monica, for all your help and.
thank you.
And your patience. Thank you.
No,
Bye.
Hey, Wendy, nice
Take care.
job.
Appreciate it.
Good to see you guys.
Okay, so